G'day guys, it's Tim Guest here, Australia's leading financial educator and Managing Director of Infinite Wealth. Here today to answer your questions, and Josh has got a question about whether it's best to use a 20% deposit when it comes to buying an investment property. Before I get stuck into it, I just wanted to let you guys know, look, we love to get your interaction with these videos, so please like, love, angry, post your comments, your whatever questions you might have so I can deal with them in our next live video down in the comment boxes below. And the only thing that I ever ask you guys to do in return for me sharing this information is just for you to share it with your friends and family. It's something that allows us to continue to build a bigger audience. And of course, it's something that just keeps me busy and it keeps me inspired to keep doing these videos. So let's check it out. Let's get stuck into it. I want to find out, or we want to get into the kind of deposit that you should be looking at using if you're going to be buying an investment property. And the first thing we want to probably address is what you can use. Okay, so based on where we're at in the current credit cycle, and you guys, if you've heard me talk about credit cycles before, just like there's economic cycles, there's also credit cycles when it comes to being able to access funds across the economic cycle. We're currently in the toughest part of the credit cycle. This is the tougher part over an 18-year period to get finance. Now, one of the things that it does is it has limited our people's ability to borrow money. One of the ways it does that is through the deposits available. So, you know, back in one of the probably stronger times of the credit cycle, I was even helping people get into homes using 103% loans. That's it. That means not only was it no deposit, but they would actually lend you 3% more than what you actually needed to buy a house. Okay, so but currently what we're looking at is 5%, 10%, 20% are probably the most common options for getting into a home. Now, in terms of the lower the amount of deposit that you put in, the less security the bank has and the more stringent they are with their requirements. So, you know, as an example, if you, you've been on a casual job for under 12 months, you might need to go to a higher percentage to be able to access the loan. If you're self-employed, you might need to go to a high deposit. But regardless of what you can use, the next thing is what you should be using. Now, my recommendation for most people is to actually get into a property. And then, of course, this is always going to be based against the background of your needs, your circumstances, and what you're out to achieve. But typically, you want to use the least amount of deposit possible, okay? As an example, if you've got $100,000 as a deposit, you know, providing that this meets your circumstances with the relevant safety nets and buffers in, you know, you could be better off using maybe a 5% deposit on, say, 2 properties, rather than just a one big deposit on the one property. Of course, the larger the asset base that you're running, the greater the leverage that you've got access to, and of course, that'll give you a greater return on your money. Like I said though, this has got to depend when it comes back to your safety nets and buffers and things like that. So where do I mean that? Now, the reason why a lot of the people are typically looking to put a greater deposit into a house, well, the first reason is this. Look, Tim, if I put in a 20% deposit, I'm not going to have to pay for lender's mortgage insurance, okay? So essentially the way that lender's mortgage insurance works is if you don't have a 20% deposit, the bank is going to take out an insurance policy against you and your loan as a risk. You have to pay the price of the mortgage insurance. However, it doesn't cover you at all, okay? There is an additional cost there. Now, these lender's mortgage insurance, depending on the property that you're buying, can typically range from around about $10,000 to $15,000. However, okay, now of course, if all it's necessary for your plan is to buy one investment property, if you want to save that money, you want to save it. But typically this is when people are starting out and they're going to be looking to acquire multiple investment properties. So what you've got to consider here is that while you might be able to save yourself $10,000 or $15,000 in mortgage insurance, it may enable you to get into the market much quicker. And if you're in the market quicker, and if we look at the 50-year growth average, here in Australia, it's 8.5%. So as an example, 8.5%, if we say a $500,000 property, you're talking in excess of $40,000 in a year in growth. Okay, so it would be a mistake to wait an additional year, try and save up more deposit to avoid paying lender's mortgage insurance. You know, maybe saving yourself $10,000 or $15,000, but in the meantime, what you've done is cost yourself to $40,000 worth of growth. The second part to this was in relation to the safety nets and buffers, okay? Sometimes people are looking to put in a bigger deposit because it provides them with a larger safety net or buffers, but that's not really where the safety net or buffer exists, okay? It is for the bank. They want security against you, hence why they want to put a deposit in to give them a little bit of room, okay, if things go wrong. However, that doesn't give you any room if things go wrong. Where you want to apply your safety nets and buffers, particularly when it comes to your cash flow, i.e. you don't want to factor in whether you can afford a home based on current interest rates. You know, as a standard, we're typically using 8 or 9% interest rates when designing strategies for our clients. That's double the current interest rates, okay? You also want to consider this when you're looking at things like the rental income that you're factoring in, vacancy rates. Once again, the worst case scenarios, I mean, a good investment area, typically you're looking at a vacancy rate of about 3%. Our worst case scenarios when designing strategies for clients are typically 6 times that, okay? So this is where your safety nets and buffers come in. Also, rather than putting that additional money in as a deposit, you could be leaving that sitting in an offset account to account for changes in possibly your circumstances around generating your income. What happens if you lose your job, you get made redundant, you're unable to work, then you've got that safety net or buffer to continue paying the mortgage while maybe you're unable to do it out of your own standard income. So essentially, guys, that's what breaks it down for me. Now, keep in mind that all of these things that I've said are all going to be based on an individual's needs, circumstances, and goals, okay? So if you want to invest in property and you're looking at what is going to be best for you, you certainly want to speak to a financial specialist. Obviously, we're here to help, but if not us, then definitely someone else to make sure that you're getting the right advice before you're taking any action. But apart from that, guys, if you want to get along to one of our live events and hear me talk about a plethora of other different issues, we've got a couple of live events coming up over the next couple of weeks. Tuesday the 16th of October, I'm going to be in Perth. Wednesday the 17th, I'm going to be in Melbourne. I'll leave you some details or some links in the post above. Come and see me. Would love to meet you. Would love to answer whatever questions else that you guys got. Like I said, one last reminder, if you want to get your comments or your questions answered, please put them in the post below. And please share this post with your friends and family so that we can continue getting this information out there and build a bigger audience. Thanks a lot, guys. Have a great week. I look forward to doing another video in the next coming days, answering someone else's question. Hope it's yours. Have a great night, guys. Bye-bye.